right, so Thursday we'll do a team cut case. Yeah, I did well on the one last week, so we won't do that one again. My guess is this one for Thursday we'll have to do twice because I'm not expecting much, mainly because students struggle with it, because part of it is just getting used to the way I ask the question. So usually the first time through it's like kind of tough, but it's a good one to do twice, mainly because you also have to do an exam, but it's also paper 3, so it gives you a little bit of practice for paper 3. So we'll do that. I sent you to YouTube so you have some sense of it. So let's talk bond valuation. So the best way to do bond valuation is just to do it. All right, so last class we did a 5-year bond. And we did a treasury, so there's no spread. Let's do another treasury just for practice. So let's do a 10-year treasury issued 5 years ago. So it's essentially another 5-year treasury. So let's get the coupons. So go out to the treasury yield curve. I do try to make them as real life as possible. So I do try to use real life numbers. So 5 years ago would be 3, 4, 5, 2017, November 2017. And the 10 years, the third one from the end. So let's just go with 240, nice round number. So rates have done what since then? So now we're talking about the 10-year. The 10-year is higher today, but this is now 5 years. So it's the 5-year higher than 240. So that's going to be the key. So yield to maturity. So let's go get the current 5-year. I think it is higher because it may even be higher than the 10-year right now. So the 10-year is 422, the 5-year is 439. Wow, that's just crazy, isn't it? What did I just say, 439? So yields are up quite a bit. So you know this bond is going to be less than $1,000. If someone says, hey, I'll pay you $1,000 for that bond, you would take it in a second. It's like, yeah, I can. Bond that's paying me 2.4, I can take your $1,000, go buy a 439 5-year. You know, you're going to make more than that. We got to get the effective yield. Anybody remember that formula? You just think about what you're doing with the effective yield and just saying, well, our yield's 439, but we're getting a coupon twice a year, so we need to compound that. It's the exact same thing banks do with CDs when they talk about the stated yield and the APY. The APY just, if it's a monthly bond, if it's monthly, you do 1 plus the rate, divide by the number of compounding periods, raised by the number of compounding periods minus 1, if I could spell. So if you're doing a bank CD, 12 months, you take the rate divided by 12, raise it to 12 minus 1. But corporate bonds, treasuries pay twice a year. So what are we going to do? 1 plus that rate divided by 2, raised it to 2 minus 1. And it has to be higher than 439 because we're compounding 439, but twice a year. So we'll get 444. So I like to start off with a guess. So we know the percentage change in the price is going to be about minus duration times change in yield. What is duration? What was the duration on our last 5-year bond? 4.5 years. So let's try 4.5. So we'll do minus 4.5 times, well, interest rates today are 4.39. They were 2.40. So we expect this bond to be down about 9%. All right, so if it's $1,000 bond, our price, we can already say $1,000 down 9%. Our starting guess is $910. So if I get 820 or if I get 990, I know I probably did something wrong. That's going to be pretty close. We were pretty close last time, weren't we? I think within a few pennies, so we're pretty close. You can do the calculator. What does the calculator do? It does the coupon. How much is our coupon? Our coupon is going to be $1,000 times our coupon divided by 2. So we're going to get $12. So what the calculator says is, okay, well, we'll get $12 and we'll take that for all of infinities. So $12 divided by 0.0439 divided by 2. So there's the value of $12 for all of infinity. And then we're also going to get our $1,000 back in 5 years, but we're not going to get the $12 divided by infinity. So we got to take that out, and all of that's in 5 years. So 1 plus 0.0439 divided by 2 raised to the 10th. Why 10? I thought it was a 5-year bond. Why am I using 10? Because we're essentially making it every 6 month. So we're making it a 10-year bond, a 10 6-month period bond. If I did my parentheses right, I'm not sure I did. So that can't be right. So we know that's not right. So there's something wrong with my calculation, but somewhere there's a parenthesis problem. Y'all see where the parentheses problem is? There should be one there, shouldn't there? Divided by that, raised to the 10th. And just keep going, but I can't get a what I do wrong. So that minus that should all be raised. I don't know why I can't get that. I need to get the denominator. There we go. Divided by all of that. Does that look closer? So that's what the calculator is doing, but it's, you know, the biggest issue is parentheses more than anything. So that's probably correct. But let's see. So we have time, you have your cash flow, you have your discount factor, you have your discounted cash flow. So time, we get a cash flow in 6 months, we get another cash flow in another 6 months, we go out 5 years. On that, my cash flow is going to be 12 till the very end, and then I get my $1,000 back. Bill Gates, he is never of help. Yeah. We got to get rid of the escape key for Zoom and the help key for Bill Gates. So there's my cash flows. How hard was that forecast? Do you have any confidence in that forecast? It's a treasury bond paying a 2.4 coupon. What's the chances you won't get this cash flow? If you don't get this cash flow, the world comes to an end because the US government's not paying off its debt. So that's a fairly easy forecast. All right, and then the discount factor, +1 divided by 1 plus our effective yield. Raise the time. Used to get something like 0.99, 0.98. I'm not used to seeing 0.98 because I'm so used to such low interest rates. My discounted cash flow, I just multiply across. Copy that down. And so here we have the table. That looked pretty close. On the exam, which one do you have to do on the exam? You may remember. You have to do one of those three approaches on the exam. Any guesses? Get credit. Somebody in the room knows, they're just not saying. So you have to do the table. I won't give you a 5-year bond because that takes too long. I'll probably give you a 2-year bond, but you have to do the table. I want to see that you know how the calculation system work. But if your calculator does the work as well, you can certainly plug it into your calculator and do that. You don't have to plug this formula into the calculator. You can just use the calculator's actual function. It's pretty straightforward. And then my estimate's off a little bit, probably because my duration's off a little bit, but this does make sense that the actual value is higher than my estimate. Why? Because this is duration, but maybe this bond has a little bit of positive convexity, and it probably does. So that's the reason you'd actually expect a higher number, because you have some positive convexity. But let's calculate the duration. You don't have to do that on exam. I've had students actually calculate it on the exam, but you certainly don't need to do that. So we just want to know, here's our cash flows. The average is 2.75, but we're not going to take just a straight average. We're going to do a weighted average with the discounted cash flows. So earlier cash flows get a little more weight just because they happen earlier. All right. So duration should be lower when interest rates are higher, because you're going to hit those later cash flows harder. And that's a question on the CFA exam. What happens to duration when interest rates rise? Well, duration is going to fall when rates rise. Why? Because your weights way out here in the future are going to get smaller. Does that make sense? Interest rates are higher, durations are lower. Interest rates are lower, durations higher, because so much weight is here. That number is going to be a lot smaller with higher interest rates. So to get the duration, we just take time times that divided by the total. So what did I guess? 4.5 years. Ooh, I missed it by quite a bit. 4.72, 0.773. I'm not sure why it's so much higher, but anyway. So there's my duration. That doesn't make sense to me, so I'm not real sure why I got such a different number. Because my coupon was so much higher. Okay, that makes sense. Okay. When your coupon's higher, you're moving cash flows up earlier. So we were doing a 20-year bond, so our coupon's higher. That makes sense that the duration is going to be lower, because this cash flow is so much larger. You're putting more weight up earlier. You're getting more of your cash back faster because your coupon's bigger. It took me a while on the CFA exam to get. I had to almost do a table to say, okay, higher coupon, higher interest rates, lower coupon. What does that do to duration? So now it makes sense, because my coupon was so much higher. The coupon's higher because it was issued 15 years ago. This one was only issued 5 years ago when interest rates were already pretty low. So we moved a lot of those cash flows out into the future. So we get a 473. Now, if you take John Tuohy's fixed income class, he goes into this a whole lot more. This is really, there's a whole chapter just on duration in the Fabozzi book. It's a really important concept. And it gets to be fairly second nature if you're in this every single day. All right, so that's how Treasury works. Treasury 1, Treasury 2. So let's do a corporate bond, which is what you're going to actually do on the exam. It's a corporate bond. That's where we get down this concept of spread. A spread is how much extra return you're getting because you're taking some credit risk. You remember spread from exam 1. During a recession, spreads do what? Gap out, widen, or narrow? In a recession, spread should do what? Widen or narrow? The exam wasn't that long ago, was it? You get a recession next year, what are spreads going to do? Someone's got to say something here. They're going to widen. Thanks, Joshua. So they're going to widen. Why? Because things are riskier, so you get paid more for the risk. So spreads widen. And the spread is over the benchmark rate. That's pretty straightforward. If you're using a 5-year corporate bond, you use a 5-year treasury because they both play twice a year. It's real important if we're doing corporates and treasuries because a mortgage or a mortgage-backed security, if you have a 30-year mortgage-backed security, you don't use a 30-year treasury. You use a 10-year treasury, and that's because mortgage-backed securities pay interest and principal, so their duration is much shorter. So you try to match not maturity, you try to match duration. So a 30-year mortgage probably has a duration closer to a 10-year treasury than to a 30-year treasury. So you actually use the 10-year treasury to price mortgages. But we're not doing mortgages. Why? Did we price a mortgage? How hard is the forecast on the mortgage? The treasury is really easy, wasn't it? We knew exactly what we're going to get. But a mortgage, you loan money on a mortgage and interest rates fall, what's going to happen? You might get all your principal back because they refinance. That's a really hard forecast to do. Are they maybe paying extra principal every month? And then suddenly they stop doing that because rates have risen, then you start getting less cash flow. So mortgages are really, really tough to price, but corporates are pretty straightforward. So let's do a corporate. Well, let's talk a little bit about it. I shouldn't have. I'm going to stay out of a screen. So we talked about this last time. AAA bonds are going to have the narrowest spread, mainly because they have the lowest probability of default. CCC are going to have the highest spread because they have a very, very high probability of default. All right, we did that. So here's the key terms we're going to have. We're going to use this. Well, this isn't actually current rates, but I'm going to use this. So these are spreads. These are corporate spreads. I say current, they're actually higher than current. But so what is this right here? 82. What does that 82 mean? I remember I was doing debt for a church and the bank bid prime minus 25 and the pastor's real excited. Buy prime minus 25%. That's like they're going to be paying us money. I said, no, it's not 25%. It's 25 what? Basis points, right? So 82 basis points is what? 0.0082. All right, so everything's in basis points here. There's two things you'll notice. As we go down in quality, what happens to basis points? The spread gets wider and wider and wider. That makes sense. A riskier bond should have a wider spread. What else do you notice? What do you notice when you go across time? Spreads widen as well. Okay, so that's the spread for credit risks. We also have what we call the term structure of credit spreads. That as you go out in time, spreads get wider, even for the same credit quality bond, which that makes some sense as well. If you're going to loan money to someone that's BBB for 1 year, you're much less likely for them to default than they will over 30 years. So you need a little extra to cover you for the spread. So you have the term structure of interest rates. That's the yield curve, which is normally upward sloping. It's not right now. It's negatively sloped because people worry about recession. But that's the term structure of interest rates. There's also term structure of credit spreads. As you go out in time, spreads get wider. I don't know if there's ever been a time where this wasn't the case. Longer term had higher spreads. I'd have to go back in history and see. I don't think so. There's certainly been times where this wasn't true, when interest rates were actually negatively skewed. All right, so let's do a, let's see. I can't give you much history on this, but I'll make up some numbers. So let's do a 15-year corporate issued 5 years ago. So what's my term here? Someone yell it out. 10 years. All right, so let me give you some tables and let's just look at this. Let's give maturity, rating, and yield, and spread. I'm not sure I've done this before, but let's say 15 10, 5. So this is the risk-free. Let's say for 15 years, let's say it's 4.4%. For 10 years, 4%. For 5 years, 3.4%. Let's say this bond was rated AA issuance. Today is BBB. All right. We do the spreads. So AA, BBB. Oh, I don't know how to do this, so I'm gonna do it over here. So let's say the spread here is 55, 50, 45. Here's to 10.80, 140. All right. And let's say the coupon on this bond is 6 point. No, let's go further down. Let's go 4.2%. All right. So what is the yield to maturity? Looks like I've given you too much information, but I have intentionally, just to see if I can throw you off. Right. So first of all, what time period are we looking at? Just 10 years, right? Everybody agree with that? We don't care about the 15. I don't know why I gave you the 5, but 10 years. And what credit quality we care about? BBB. So the key is we only care about where it is today. That's all that matters to figure out this bond. The fact that it was rated AAA, all that tells you is it has a pretty low coupon because the coupon was established when it was much higher credit quality. So that means you have a lower coupon, which is going to make it price have fallen more. So my yield is going to be that number right there. So my yield to maturity is going to be 4% plus 180 divided by 10,000. You remember that's how you get the basis points. So my current yield is going to be 5.8. Now, when it was issued, maybe the risk-free, let's say, was 3.7%, and the spread was 0.5%. That's how we got the 4.2. So this bond price is going to be down. Why? Partly because interest rates have risen, but also because it got downgraded. So this bond's price is falling because general interest rates have risen and because it got downgraded, which probably had bigger impact. Well, the risk-free rate's up 30 basis points, but their spread's up 130 basis points. The bond price is down more because of the downgrade than because of rates being higher. Right. So, all right. So let's price this bond. We still need the effective yield. And then we'll do a guess here. Let's see, 10 years, boy. I'm really, really bad at this. So we know it's probably more than 9, probably less than 9.5. I'm going to guess 9.2, but boy, we'll see. I'm going to be way off on that. And so my guess is going to be minus 9.2 times the current yield is 0.058. We started at 0.042. So this bond should be down about 14%. We'll see. I could be way off on that, but we'll see. That's my guess. Your calculator. See if I can get this right. So what's my cash flow? So $1,000 times 4.2 divided by 2. So I'm going to get a $21 coupon. So $21 divided by 0.058 divided by 2. So the value of the coupon for all of infinity is $724. And then we're going to get $1,000 back, but we're going to lose the 21 divided by 0.058 divided by 2. But we're going to, that's going to be 10 years from now, right? So raise it to the 20th. Does that look possible? That's probably the right answer, I would guess, because my duration is probably way off. So maybe my duration is only 9 years. Who knows? We'll see. All right. So then let's do the table. Can anybody give me the titles for the table? Cash flow. I'm sorry, time. You said time, right? Sorry. Time, cash flow, discount factor. And then UCF. So time's gonna be pretty massive here because we could go out 20 periods. My cash flow is 21. Now, did y'all know there are infinite bonds that have been issued? Have you ever heard of those? They're bonds with no maturity. How would you value that bond? It's pretty simple, isn't it? You just take $21 divided by 0.058 divided by 2. That's how you price that bond. So they're bonds that have zero maturity. I mean, infinite maturity. They're going to pay interest forever and ever and ever for all of eternity. It's not worth infinite. It's only worth 724. So there are bonds like that. Our discount factor plus 1 divided by 1 plus, make sure you use the effective yield. Raise the time. Cash flows. I look pretty close. Close, isn't it? Let's see if Bill Gates thinks it's close. Yeah, exactly on. And you need to have that while we're rounding this. I'm going to calculate duration just for the fun of it. See how far off I was. I'm really so out of practice with higher interest rates. Wow, look at that. I was really off. So yeah, I just can't handle higher interest rates. Higher interest rates really reduce that duration. And so, yeah, you're still off some, right? Because of convexity. So this bond has a lot of convexity. So duration would say the price would have fallen to 870, but it accidentally fell to 880 because of the convexity. So that's still okay. But can you see the duration? If you get the right duration, you can see it gives you a pretty good estimate. It's going to be further off the longer term the bond is. So if we did 20, 30-year bond, you have a lot more convexity. It's also going to be further off the more interest rates change. All right. So this bond fell 13, or this bond fell 12%. What if interest rates had not changed? What if the 10-year was still at 3.8? The risk-free was 3.8. It would have fallen 11%. Well, at the spread, it stayed at 50. Would have, so most of that drop, 10% of that 12% drop was because they got downgraded. Only 2% was because interest rates rose. So most of that bond's price fall was because it got downgraded. So something, if you take my risk class, I think I saw a few of you are in there. When you're talking about credit risk, there's two types. I don't know if John Tui talks about in this class, he might. We talked about one before, default risk. And that's certainly a risk. The bond goes in default, goes in bankruptcy, but this bond isn't bankrupt. And yet its price fell 10% because it got downgraded. So that's that's the other kind of risk, which is downgrade risk. That's spread. And in that case, yeah, the bond price is going to fall because the bond got downgraded, even though it's still paying on time. Look, you think you can get on, you have a high probability of getting all your money back. It was a AA, now it's BBB, but BBB bonds, you know, you got a 90-something% chance you'll get all your money back, but still you lost a lot of money. You lost 10% just because they got downgraded. So that's still a risk. So those are the two risks. And this bond suffered quite a significant downgrade. Right. Can y'all do these on your calculators? Have y'all tried? Plug them into your calculator. I wish we had Excel on exam because we could do a whole lot more with Excel. It'd be a lot more fun. Let's try it. So equal PV. I don't use Excel functions like this. What's my rate? 5.8 divided by 2. Net period is 20. The future value is 1,000. I don't think we need a payment, but geez, no. Oh, y'all figure it out. I can't remember how to do it, but that's how you do it on your calculator. I don't use these functions. I prefer to plug in the formula. I don't like black. You know, you might be great putting it in the calculator, but do you know what the calculator did? Would you rather know this or plug it in the calculator and it does that for you? You don't know what it did. You're much better off knowing exactly what the calculator did. Plus, you want to have a calculator. Trust me, I've been there several times. It's like, I need a calculator. Everybody's like, I don't have one. They might have one. They might have a calculator. This is in finance. No one has a calculator because we don't use calculators. We use Excel. So, all right. Now, if you're taking the fact exam, yeah, you got to figure this out in Excel. So figure out how that is, work that out in Excel. Someone figured that out and we'll do it. I'll show y'all next class. All right. So interest rates rise, bond prices fall, interest rates fall, bond prices rise. For a corporate bond, you have both the risk-free rate and the spread. So risk-free rate can fall and spreads can gap out or narrow. There's all kinds of scenarios that can happen. So think about the early 80s. The risk-free rate fell dramatically. Spreads narrowed. And why did they narrow? Because we had 2 recessions. We came out of those recessions because the Fed was killing the economy to bring inflation down. So we came out of a recession, interest rates were falling because inflation's falling. You would have made a lot of money on corporate bonds in the 80s. It would have been wonderful. The 2020s, 2022s, what's happened? What's the risk-free rate done this year? Rise, fall, pretty dramatic. What did spreads do? They widen some, it depends, because high yield bond spreads have widened quite a bit. So let's just look and see. It'd be interesting to see. Let's try a Vanguard Treasury. Treasury bond fund. Year to date, it's down 15%. It's US Treasury, then let's try Vanguard corporate. They don't have one. Let's try this one. Here's a corporate bond fund. Oh, they don't show it. Maybe is it Victory Capital now? Yeah, I don't know why I can't look up. Let's try total bond. Ah, frustration. They won't tell me what the year to date is. All right, I give up, but I'll try to find some for next class. It's very interesting, especially if you go back to 2008. 2008, boy, I wish I could show you 2008. Let's see if the Vanguard will do it. Doesn't go back that far. All right, so I got to find one to show y'all. So I'll have to find some bond funds to show you. 2008 was an incredible year. Let's see if y'all were what, in first grade then or something. Anybody have any idea what happened in 2008? Risk-free rate and spreads. What happened in 08? Risk-free rate did what? Fall or rise dramatically? Fall dramatically. So treasuries rallied strong in that year. What did spreads do? Widen a whole bunch. So corporates fell dramatically. I think I'll tell you before I did analysis where this difference was even worse than what we saw in the Great Depression. Treasuries, the difference between corporates and treasuries, that was the widest we've ever seen. It was just absolute insanity. Treasuries up 20, 25%, corporates down 15, 20, 25%. It was just amazing. And the problem with mutual funds is they don't like to buy treasuries. So they didn't have any treasuries. They avoid treasuries because the yields are too low. And so mutual funds out there, you know, the treasuries up 20% and they're all losing 15, 20% because all they own is corporates. It was an incredible year. And I was on a committee where we had to meet anytime a bond fell more than X%. My first 2 years, that committee never met. And in 2008, we're meeting almost daily sometimes, but every week we're meeting because what was happening is people were scared to death. So they weren't selling any of their bonds. They're just holding them to them. So we didn't have a price. Kind of like real estate, right? You don't know what a house's price is until you sell it. So we'd have a price, and then suddenly someone in Wisconsin would sell a little bit of that bond, and suddenly we had a price. We had it on our books at 80. They sell it for 60. Now we had to figure out what's this bond worth. It's like they've sold us a little bitty piece, but they sold it for 60. We now have a market price. And we had to, as a committee, decide. So y'all probably don't. If I want to know what Apple's worth, what would I do? Maybe. Any guesses so I could figure out what Apple stock is worth? Could I maybe type AEPL 139.50? Does that sound like what Apple's worth? But if I want to figure out what a corporate bond's worth, what do I have to do? Well, corporate bonds don't trade every day. There's a lot of corporate bonds, they just sit there in people's portfolios for the longest time. And then suddenly someone sells one. People sell by Apple every single day, but corporate bonds can sit there. So you have the market price based on two things. You got a transaction, but that may not happen all the time. Then you have theoretical price based on models. So what was happening in 2008 is we had our models, and our models told us, hey, based on our models, this stock's worth 80. I mean, this bond's worth 80. And no one else is trading the bond. So the best we have is that model. And the model says the bond's worth 80. So that's what we stick on our books is 80. We might look at similar bonds that might trade, but they're all a little different. And then a transaction happens at 60, very different than our models. We got to decide how to reprice that bond. So it got pretty humorous in 2008 because we would call our broker and say we need a price for our bond, and the broker say, oh, it's 80. And so we put 80, and then the bond portfolio manager says 80. Well, let's sell the bond. If I can get 80, that sounds great. So you call the broker back and says, hey, we want to sell the bond. Oh, you want to sell it? Well, then it's 60. Well, where'd you get the 80? The 80 is the theoretical price from the models, but there's no liquidity. No one's buying bonds. So if you want to actually sell it, the true price is 60. Like, forget it. I don't want 60. I want 80. But that's the way 2008 was. We get those type of markets every decade or so. It gets pretty crazy. 2008 is probably the worst ever. I was a stock portfolio manager, so I was just listening to them all crying and weeping because they were all, I was like, this is like a normal year for stock guys. Or they're like, no, we never see that. We're bond people. We're supposed to have really easy lives. And they really got crushed. It was a tough year. So bonds are a little bit different, very, very different, because they're not nearly as liquid, especially corporate bonds. We know treasuries every day. We can price treasuries because they do trade. For corporate bonds, much more difficult market. And you might say, well, I got a mutual fund that's full of corporate bonds. That's true, but those corporate bonds in the mutual fund, they don't trade every day. So that mutual fund is guessing on prices. And so you don't really know what the fund's really worth until they sell all of their bonds. So it's interesting. It's a very different world. All right. Questions on that? So let's try the thing I mentioned to you earlier. I know it's dangerous. I keep doing this, looking for stuff in class. So you just type Moody's default steady, and let's see what we can get here. Does it look like anything's happened here recently? That's a pretty wild chart, isn't it? What does this look like here? 2008. So you notice how bonds lives are really boring until they're not. It just goes absolutely crazy. I'm going to find the PDF. (2010). I've got a few of these studies that I saved. They don't, I can't force them to give me their studies because I'm not paying them any money. So I'm kind of at their mercy, but they do publish these. Moody's more than S&P. This looks like this might be a good one because it's taking forever to load. So it's probably several pages. Yeah. Oh, this is S&P. So here we got a 2021. So it's 130 pages, but it's a lot of graphs and charts. So, some of y'all, if you interview with like Victory Capital, you would want to read this report before that interview. So if y'all saw what I just loaded, I can save it in case y'all want it. Y'all want me to put this out on Blackboard? It's already pretty old because it's 2021. Here's the default rates. Rating actions, that's to me is really interesting. How many bonds were upgraded versus downgraded? So in a recession, you'd expect a lot more downgrades than upgrades. And if you look here, 2008, 2009, you had a lot of downgrades and not many upgrades. This last year, 2021, we had a lot more upgrades than downgrades. But in 2020, why would 2020 have been so bad? COVID. All these retailers, all these energy stocks getting downgraded. Maybe this is energy stocks getting So really interesting information. I don't know what that is. So you just have to read through it and see what they're presenting. So it's 130 pages, but the actual reading might only be about 10 pages. So it's not that much to read. You just look at the data, and obviously get a table like this. You're just kind of eyeballing through it just to see what's going on. And they, something, you talk about in an interview, if you want to talk to like someone who's not an undergraduate student, then some of these, like the upgrade, downgrade analysis, that can be something not very many students are going to talk about. Upgrade versus downgrade, spread history, defaults. So you could definitely say, okay, 2021, there were a lot of downgrades, but how many defaults were in 2021 or in 2020? Go back to 2020, a lot of downgrades, but not that many defaults. That's kind of interesting. That would be a really good insight to have in an interview. So I'll put this out there if I remember. I'll put this out there on a Blackboard. Your key in an interview is you want to sound like you've been in the business for years. And you're not going to do that if your entire knowledge is a textbook, because bond people don't sound like textbooks. They sound like bond people. So it's a very different lingo and language you've got to get. So, all right. So there's bonds. Any last confusion or questions on corporate bonds? You did this in 2013, so it's kind of just a redo. So every undergraduate finance student can do this off the top of their head without even thinking about it. So it's just one of the things we know. Probably most accountants can do this as well, because accountants price bonds because they have to do the evaluation for them. So, all right, let's talk about stocks. I stole this from Dr. Damodaran. So he says, what's a value of a stock? What's the present value of the cash flow? What cash flow on a stock? So it gets really confusing. The obvious cash flow is they pay dividends. So we could say the value of a stock is the present value of its dividends. But then Alphabet doesn't pay dividends. So does that mean Alphabet's worth zero? Some stocks don't pay dividends, but they buy their stock back. Stock repurchases, that's a cash flow. Can we include that in our analysis? Some firms have never paid dividends, but they're producing an incredible amount of cash flow. So we maybe, instead of present value of the dividends, we do the present value of the cash the company's producing. We value the firm versus valuing the stock. Okay, we do that. And so Damodaran's saying the value of a stock is, first of all, the existing company. We're going to talk about that valuation. I call it capitalized earnings. He doesn't like that term, but that's the term I'm going to use. So what's the value of the firm as is? Of existing assets. They don't add any new stores. They don't expand overseas. You just stick with what they have today. What would that be worth? And then we're going to take the future growth, the value of growth, and that's that CapEx, expansion overseas, new products. What's the value of that growth? And then they hit some steady state. So you have the as-is company, then you have all this addition, and then eventually they just steady state. They can't grow anymore. They've done everything they can do. It's once Walmart's on every single corner in the world, they can't add any more stores. It just gets ridiculous. Once Netflix has 10 billion customers, they're done. They can't add any more. All they can get. What I like to say is, eventually your growth is inflation plus population growth. That's all you can do. Once you saturate the world, and once Netflix has every single human in the world using their product, they can't grow anymore other than population growth and inflation. So that's that final steady state. So existing assets, growth, and then the final company when it hits its final state. Now, who's in this? Some companies may already be where this right here is the same as this. They're already in that steady state. I don't know kind of companies that are like that. Maybe Camel Soup. I don't know. Is Camel Soup expanding and doing great things? Maybe they're selling more soup in emerging countries. So maybe that would be one. There's probably quite a few companies that are in this steady state already. Most firms are doing some stuff to try to grow and get more valuable. And then we got to adjust for the risk. So every firm has a different level of risk, so we have to adjust for risk. So he's This is his model of the value of a company. I think it's a pretty good way of thinking about it. It is discounted cash flow, just like we did with bonds. It's just that we have to value CapEx and growth and all those kind of things. So he says it's simple. I like what Warren Buffett says. Finance is simple, but not easy. It is simple. The concept's simple, but actual execution is quite complex. For cash flow generating assets, the intrinsic value will be a function of the magnitude of expected cash flows on the asset over its lifetime and risk, the uncertainty about receiving those. Now this is his way of making sure you don't make stupid mistakes in your valuations. If it doesn't affect cash flows, it doesn't affect risk, then it's not a value. So what is Elon Musk doing right now to Twitter? The most obvious thing he's doing right now. What's the news talking about? Cutting staff. Is that going to affect cash flows? Definitely. What's the other thing he's trying to do? Add an $8 a month. How many of you got the $8 a month Twitter? Yeah. What's that going to affect? Cash flows. He's talking about these new committees to say what's acceptable, what's not acceptable, creates a lot of uncertainty. That's going to affect risk. So maybe his discount rate's going to go up. But he's doing a lot of things. So that's not, we can't ignore those. But what Demodarian's saying, if it doesn't affect cash flows, doesn't affect risk, then it's not important to a stockholder. Just don't care. You might say, well, if we do this, our employees will be a lot happier. Well, if they're a lot happier and they're more productive, then that gives you more cash flow and you can value that. If you're a lot happier and you don't get any more productivity, then you just have happy employees, but the stock's not worth anything more. So you got to figure out, so don't talk excited about a company, oh, they're doing this, this, and this. The question is, does that increase their cash flows? Does it reduce the risk? If it doesn't, then that's not valuable. For an asset to have value, the expected cash flows have to be positive. So that's the dove proposition. You got a firm that's just losing money, hand over fist, but man, they're doing exciting things. Well, for them to have any value, they eventually have to have positive cash flow. That seems pretty duh, but there are some stocks out there, and especially in 2000 during the dot-com bust, we had companies, people were all excited about it because they had their title, the name of the company had .com in the name, but they really had no serious prospects of having positive cash flows. So they're worthless if you can't produce cash flows. And then assets that generate cash flows early in their life will be worth more than generate cash flows later. The latter may, however, have greater growth. So that's what we're trying to mess with. Value stocks who have a lot of cash flow today, but may not be in existence in 20 years. And growth stocks that may not be producing a lot of cash today, but are going to produce massive cash flows in the future. We've got to somehow balance those two out in some way. And if you haven't watched his videos, I highly recommend them. There's a couple of them I really, really love. One called Stories. Oh, that's not how you spell YouTube, is it? So this one I hear, The Value of Stories. Have any of y'all watched this one yet? It's really exceptional. Really, really great, great, great video. He says there's a quant side and there's a story side. So the quant side, you got a bunch of numbers. The story side is explaining the business and what they do. So really, really good. He's a great speaker. He was at Google doing this talk.
Billionaires, no, billionaires, get out of here.
There, I think he's talking about Ferrari. So really, really good. And then the other one he does that's really good is the life cycle. Really, really excellent presentation.
Mature companies can think about financing mix.
So what he's saying is there's some CEOs out there managing mature companies, but trying to act like they're teenagers. They're trying to manage a mature company like it's this young, fast growth company, and they're making fools of themselves. Kind of like me on the skateboard this last, 2 weeks, trying to be a 60-year-old, trying to look like I'm 20 or something. It looks idiotic. You end up breaking your neck. But then there are some young companies that are acting like they're mature companies. They're borrowing a lot of money. If you're a young company, you want to borrow a lot of money, it's going to restrict what you can do. You got this debt payment you got to make. So he's talking about what's the characteristic of a young company, what's the company of a mature company, and you don't want a young company that's being managed like a mature company, and you don't want a mature company being managed like a young company. It's really quite exceptional. And it's this one right here because he's got 3 or 4 of these. It's the one where he has the big great background. Don't do the other ones. This one's about 30 minutes long. Really good video. So I recommend you listen to these. He has a lot of others. I mean, just look at, well, you got all my music videos, but just all of them very, very good. And he has his class is online, so you should watch some of his classes. He's got his graduate class from NYU is online. You can watch that. You can probably understand most of it. He has a few things that are pretty advanced, but a lot of it's not all that advanced. Okay, so we're going to be valuing stocks, and the most important thing you got to do in paper 4 is you got to come up with some growth rates, because paper 3 is the discount rate. We'll talk about that more when I do an example run. We've already gone through it a little bit with beta and CAPM. But paper 4 is valuation. Well, valuation is fairly simple because you're just plugging numbers into a formula. The challenge is to actually get the numbers. So paper 4 is a little challenging. So in your 3013, we probably gave you all these numbers. We gave you beta, we gave you the growth rates. So now in this class, you got to come up with your own numbers. And that's the important thing. In fact, I think most of my college career, they just gave us all these numbers and we plugged them in the formulas. We're asking if we could plug 3 numbers into a formula. Well, obviously we can do that. The hard part of finance isn't plugging the numbers into the formulas, it's actually coming up with the numbers. So what growth rate are you going to assume? And there's, on paper 4, there's 3 things you got to think about. First, you need some basis for the growth rate, which I always anchor everything to economic growth. The economy is growing 5%, you got a company growing 20%. It's not going to grow 20% forever. It's going to have to eventually come down to 5% or less because it becomes mature. So you always keep that growth in the economy in there. Anything from 4 to 6% makes sense. Remember, you're doing this, you're going to do this on paper 3 when you come up with your beta. We'll talk about that more. I'll walk through it. Then you start thinking about your industry. Is this a growth industry or is it a declining industry? So artificial intelligence, what is that? We hope that's growth. We're right at the edge of that you're going to take over. Neuroscience, that's probably hopefully a growth industry. So is your industry high growth or not? Now, hopefully have y'all had Porter's 5 forces sometime? Anybody? Y'all know what it is? Can anybody name the 5? It's right there. Buyer, supplier, barriers, threats of substitutes, a rivalry within the industry. So Porter's is used a lot in finance and investing. Try to help understand an industry. It's an industry of advantageous, strong industry. That means the industry has power over its buyers. The industry has power over its suppliers. It's really hard to get into the industry because maybe you need a brand name or you need a lot of CapEx. There's not any really products that you can substitute for it. And there's not a lot of rivalry within the industry. People aren't fighting over market share. If you have that, well, you've got a great industry. It's just going to be kicking, doing very, very well. You have an industry where the buyers have all the power, suppliers have the power. It's really easy to get into the industry, easy substitutes, a lot of rivalry. Maybe you could say like restaurants. We can go any restaurant we want to. Suppliers, maybe suppliers don't have as much power there, but real easy to start a restaurant. People can eat at home. People can do DoorDash now. I mean, it's pretty easy to substitute. And there's a lot of rivalry within the industry. If you've noticed with restaurants, a restaurant comes along, everybody's really excited about it. And 5 years later, you know, Applebee's, how many of y'all go to Applebee's? Probably, any of y'all been to Applebee's in here? Probably never, maybe a little bit, probably with your grandparents or something, right? We don't go there too often. I kind of like Applebee's, but it's kind of gotten a bad rap. Red Lobster, another one. I kind of like Red Lobster, but y'all wouldn't go there. Y'all wouldn't be caught dead there. Olive Garden has a bad rep, but it used to be really, really famous. So what's the leading restaurant now? What do y'all go to? Is there one y'all really like? What's Chipotle? Is that still cool or is that lost? It's so, Subway's kind of falling out. So, you can do great in a restaurant and 5 years later, you're already has been. So it's a tough industry. If you're a defense company, you have one buyer, U.S. government, but that's maybe an issue, but you have quite a bit of power of your suppliers. Barrier entries are huge. There's really not a threat of substitutes. Instead of using jets, we're going to use something else. Maybe drones are coming in, but some industry much more protected. So Porter's 5 forces is really powerful. So you have to think about your industry. Is this a fast growing industry or a slow growing industry or mature industry? And that's somewhat what Damodaran's talking about in the life cycle. There's a normal life cycle to all businesses. They have high growth, mature growth, and decline. So where's your industry? And then also start thinking about economic moats, which really comes in more to the company. I should have put economic moats under the company. So you look at the industry, then you start talking about the company. Is this company growing faster than the other companies in the industry or more slowly? Does it have economic moats, some protection from competitors so it can sustain itself much faster? So Apple had an economic moat in that people just viewed Apple products as superior to the competition. And because of that, they can charge more. Their margins are much wider. Tesla has an economic moat that people consider Tesla to be a superior car to a GM or Ford. And is that true? Is the Tesla EV better than a Ford EV? Would y'all say yes on that or no? Is it a better car? And how do you know it's a better car? Have you test driven them? You look at the standards, or you just assume they are. Is Nike better than Reebok? If you wear Nikes, will you win more basketball games if you wear than if you wear Reebok? Have you tested them out, or is it all just marketing hype? So that's economic moat, brand name, reputation, those kind of things can be economic moats to protect you. Facebook had an economic moat, and that it was a platform company, that it had a corner on the market. Once you become the corner of the market, it's hard for anyone else to start because all your friends are on Facebook. Why would you go anywhere else? And now Facebook's starting to decline. So those are the kind of things you're looking for. Does this firm have something that protects them from the competition so that they could actually grow faster than our competition? So you say, okay, the economy is going to grow 4 to 6%, but this is a fast growing industry. Maybe it's growing 8 to 10%. And my company has a huge economic, sustainable competitive advantage that's going to allow them to grow faster than the competition and sustain that for quite a while. Not forever and ever and ever, but sustain that for quite a while. And so maybe if the industry is growing 9 to 10%, maybe my company is going to grow 10 to 12%, right? So you're just trying to get some basis for growth rates. So I'm going to give you a few ways to figure out growth rates. One thing you can do is just get history. So you can use Capital IQ to do this. I'll show you real quickly how to do that. Do y'all have Capital IQ accounts? So if you don't have a Capital IQ account, you need to get one really fast. Let's see if this machine has it on it. It may not. It doesn't. Nope, it doesn't. All right. So Capital IQ, you just go to UTSA, go to the library. You absolutely got to get Capital IQ onto your resume. And Capital IQ just started an academy where you can take their courses and get certified. And if you want that, I'll forward it to you, email me, but you can take it. It's a class. So just go to the library, look up databases, just click on C, find Capital IQ, set it all up. It'll take you 3 tries. It never works the first time. I don't know why, but set up your own account. No one in here has a Capital IQ account. Is that true? You do? No? No one? Triple you do. All right. Okay, so y'all been in investments today, right? So investment, Joseph, you have yours yet? Okay, let's see if I can get in. I can never remember my password, so that would probably. It won't work the first time. Yeah. So anyway, I can't remember my password. So get an account. When you get an account, you can bring in tremendous amounts of information. I'll show you an example here. So this is a file I built for Walmart that y'all seen in my class. So Jacob and Leo, y'all remember in our class, you had that first project. That first project, I pulled everything from Bloomberg. I'm now pulling everything from Capital IQ. So everything I did is, does this look familiar at all to you? Print page 1, print page 2, that can bring back nightmares tonight, probably. So Capital IQ has these formulas that bring in information over many, many, many years. Pretty amazing stuff. I can't use it in here because I don't have Capital IQ loaded. But I can paste it as values and I don't have to worry about that. So here's our earnings per share for Walmart. What I want to do is look at a 3 years earnings per share rolling. So there's that year divided by 4. Why 4 years? Why not 3? Well, because you can do 3-year growth rate, you have to have a starting year. Then you have 3 years. Raise that to the 1 divided by 3. It's 1. Oh, man. There it is. I don't know how they happen. All right, so there's Walmart's growth over 3 years, 10% consistently, and then Amazon showed up. And then what showed up here? They were doing pretty badly, right? And then suddenly something happened 2 years ago. COVID was good news for Walmart, wasn't it? When you have people lined up with shopping carts a mile long to get into your store, that's usually a good sign. Their problem was supply. They couldn't, if they'd known COVID was going to happen, they could have really made a lot of money, couldn't they? They could have bought, 7 years worth of toilet paper and put it in their store. They would have made a fortune. So what do you do going forward? Well, Amazon's still around. Are we going to, how many more COVIDs are we going to have? Hopefully no more. Pretty tough to figure out what their growth is going to be going forward. Do you think Walmart's going to grow 10% for the next 5 years? What do you notice about COVID? They're already starting to lose some of that. The history gives you some really good insights into the company. If you use Capital IQ, you can bring in the last 20, 30, whatever years. You can just calculate historical growth rates and just look at them and just see. Because the fastest they've ever grown is around 10%. To tell your boss, oh, I think they're going to grow 22% going forward, you're going to have a hard sell on that unless you can somehow argue they're just doing something radically different. Now, Tesla, we couldn't do this with Tesla because Tesla, almost all of these numbers are negative until just recently. You can't do a growth rate from a negative to a positive number. So it's just impossible. So some you can't do, but history is one way to do that. And I recommend you use Capital IQ mainly so that you can put it on your resume that you've used Capital IQ. Capital IQ hardly existed 5 years ago. Now it's all over the place. A lot of people are using Capital IQ. So you got to get Bloomberg Capital IQ onto your resume, and it's pretty easy to do. You can teach yourself. The second approach is, what does the market think? What does the market think your stock's going to grow? We can find that in what's called the PEG ratio. So the PEG ratio, we're going to talk about PE ratios later, but the PEG ratio is you take the PE ratio, which is price of earnings per share. The PEG ratio takes that PE ratio and divides it by what the market thinks growth is going to be the next 5 years. And so if we want to know what the market thinks growth is going to be, you just take the PE ratio divided by the PEG ratio, and you've got the growth in it. So if you're not familiar with PEG ratios, look it up. There's a lot of websites. There's PEG ratio groupies out there that love PEG ratio. It's about the only thing they use for picking stocks. It's mainly used with, we'll see later in the class, it's mainly used with tech stocks. but you can use it at other companies. So essentially, you're looking at a PE ratio may be really high because the company's growing really fast. And a PE ratio might be really low because the company's growing really slowly. So let's adjust that. Let's take that PE ratio divided by growth, and then we've got just kind of apples to apples. There's one big flaw with that, and that is PE ratios might be high, not because of high growth, but because the company's really low risk. And PEG ratios somewhat ignore risk, so that's its downside. But we can certainly use this information. So if we're looking at Walmart, you just go here where it says statistics, and you can see their PEG ratio is 3.84. And the PE ratio you want to use is the forward PE ratio, not the trailing. The PEG ratio is based on the forward. So 2294, and I'll never remember those numbers, so I'm going to bring them in. So 2294 is the PE ratio. Now that sounds like a really high PE ratio for Walmart. Walmart is not a growth company, but reason their PE ratio is so high is because they're a very low risk company. So PE ratios are high because of high growth or low risk. I don't think they're the high because of high growth. And then their PEG ratio is 3.84. So you take the 22 and you get about 6% growth for the next 5 years. Does that seem reasonable for Walmart? They were growing at 10, but that was COVID. They were losing out, but they're actually making some pretty good headway into Amazon. They're doing really well on their website and growing some overseas. 6% doesn't seem outlandish to me. So, all right. So we'll stop there, and we'll talk some other ways to forecast growth next class. All right. So let's start. So first of all, before we do that, you have an interview this afternoon. Would you talk about the markets at all today or not? How big of a day was it? This is, I think you can classify this as a historic day, can't you? That's 5 sigma event, isn't it? 5%, 5 sigma. 5 sigma, how often does 5 sigma happen? It's 5.33. There we go. So in a million days, let's see, how y'all are what? Some of y'all are 22. So in 8,000 days, you would expect to not see one. So you're seeing something today you shouldn't have seen in your life. Your 122-year-old grandfather, you would have never seen. So you're seeing something today that from a normal distribution you should never see. Now we know the stock market's not quite normally distributed. It's more in the tails than there should be. It's normally distributed except for when you get to the tails, and then it's not. So it's a pretty massive day. What about bonds? What is that? So what's the 1 day, you remember? 6.5, that's 32. How big of a day is that? Plus 32.22 divided by 6.5, that's a 5. So again, you should not have seen today. We were talking about this in Investment Society. My projection is the first decent inflation number we get, the markets are going to have this massive rally, and sure enough, it wasn't that hard of a projection to make. So yeah. And you go in there and say, yeah, the 10-year is down a bunch today, they're going to look at you funny. So the bonds are up a bunch today, almost like 3-4% in 1 day. So treasuries are almost as much up. Treasury prices are up almost as much as the stock market's up today, which is pretty ridiculous, pretty amazing. I don't know if I can find a treasury bond fund. This is not treasuries, it's corporates. It's not up quite as much. This is a bond fund. It's not up as much, but it's much shorter duration. But yeah, treasuries up 3%. I was looking at I forget the name. I forget the ticker. It's on my Bloomberg. TLT. TLT is a treasury. 20 plus long treasuries up almost 4%. That's a pretty massive day for bonds. Yeah, and why is it? Because inflation's down to 2%? No, it's down to 7.7. I love the article. They had it earlier. They got rid of the article. But the original article was inflation comes in slightly below expectations. I think they took the word slightly out later because the stock market's not thinking slightly. What were the expectations though? I don't know about that. I didn't look at the expectations. 7.7% is a pretty big number. Economists expected 7.9. So what is the stock market telling us? 7.7 is great. No, we just finally got good news. So they're like, any good news is massively good news. And so, yeah, that's good. The other question is core. Did y'all see core inflation? Is that in here? What did core do? Core CPI, that might be actually the more important number. 6.3, 6.5. So that one's really critical. So core takes out what? Two things. I remember. Yep, food and energy. So you would think energy is probably deflating that number some because gas prices came down so much, but now they're starting to go back up a little bit. Rents are been a big one and those kind of things. So yeah, this is a historical day. So yeah, you want to get ahead of you're interviewing today, you would want to get ahead of it. And you have to find some excuse to bring it up. So you say, wow, I'm really glad I can interview you today. I know you guys are going crazy with the markets. I mean, just incredible market today, pretty historic. I mean, that's the kind of thing you do. And then the next person comes in after you and they're completely clueless. What? Oh yeah, treasury. Oh yeah, yields are down. Yeah, that's terrible for treasuries. No, treasury prices are up. Gives you a huge advantage. You somehow again to get your mind into that mode, because if you don't, that's the way they think. And if you're not thinking like that, they're like, what's wrong with this person? What are they doing? And you will get that as you get into the career, but you got to get into it now. Start thinking like that. So find a way to get yourself just inundated. It's just the way we are, man. When I go meet with my friends, it's like, that's all we talk about. It's like, don't you guys get tired of talking about this? No, that's all we do. I don't know if nurses talk about that or doctors talk about their career or engineers, but finance people. What about accountants? Is that what accountants do? Get together? Boy, did you see that debit yesterday? Boy, I was expecting that to be a credit. It came in as, I don't know if accountants do that. I hope not. That'd be kind of boring, but finance people were just obsessed with this. All right, let's look at this. So let's start off with the formula. So pretty easy. The discount rate for a stock. What is CAPM? Anybody remember the formula? The most important formula in finance. Risk-free rate plus beta. The market or equity risk premium. All right, so let's start off with the risk-free rate. What does your boss say on that? So it's going to be much easier on your exam because, well, I'll probably just give you the 10-year treasury. All you have to do is know the 10-year treasury is the most common risk-free rate. But when I wrote this exam, interest rates are really low. So what does the problem tell you? She uses the forward rate. So all you got to do is find the forward rate. What is the forward rate? Producing a forward yield of 152. So what's my risk-free rate? 152. I had a lot of students miss that. I'm not sure why, because I just tell you the answer, right? It's right there. Okay, what about the market risk premium? Market risk premium is going to be the expected, because she's using the implied approach. I tell you that twice in here for some reason. Expected return minus the risk-free rate. Expected return not on Dollar General, but on the market. Right? So this is all about the market here. The beta is where you talk about the company. So what does she expect the return for the market to be? Well, expected return on the market is going to equal the yield plus expected earnings growth. So what's the current yield? I give you two yields. I give you 1.3% for the stock market. We're talking about Dollar General, so I give you their yield. Which yield do we use here? Someone yell out a number. You have 50-50 shots, so you could guess and sound really smart. Is it 1.3% or 0.8? What do y'all think? 1.3, right? Because we're talking about the market. On the market risk premiums, all about the market. Why do I give you the 0.8? You won't use it anywhere in the exam unless you want to lose points. If you use it, you're losing points. So that number is of no value to you. We need their dividend. We don't need their dividend yield. So we'll get their dividend in a later problem when we're valuing the stock, but we don't need their dividend yield. But she says there's more than the dividend yield. So what else would we do with that? She also uses the buyback yield. So her yield has both of those. So on the exam, I don't know what I'll do. I may not have the buyback yield on this one. You just have to kind of look. I mean, I could give you the buyback yield, but she says, but I don't believe in adding the buyback yield in. Then you just read it and say, okay, there's a buyback yield, but she doesn't use it. So you just ignore it. So you know, some of it is just reading the problem. And then expected return, expected growth. She says equals economic growth, but even more than that, you don't have to add the numbers. She just tells you it's 5.5%. All right. So the 5.5% is productivity plus inflation plus labor growth plus inflation. That's 5.5. And then she gives you the number right there. All right. So be careful here. Here she believes U.S. economic growth and corporate earnings growth are the same. It's possible I may give you that she thinks, well, the economy is going to grow at 5%, but I think corporations are only grow at 5 or 5.5 and 5 or 6 and 5, whatever. So read it real carefully. So you have to be careful. We're not looking for the expected growth in the economy. We're looking in expected growth of stock earnings. All right. So they're not the same. For her, they are. She thinks the economy can grow at 5.5%. She thinks corporate earnings can grow 5.5%. They're the same. In the exam, I may not make them the same. So really read the problem really, really carefully. So their expected earnings growth is 5.5%. Oh man, I can't do that in my head. 0.073 maybe, 0.083. Someone check me on that. 2.8, 8.3%. So 8.3%. So my market risk premium is 0.083 minus 0.0152. Whatever that is. I get 678. Does that sound right? That's a really high risk premium. Why? Because interest rates are so low. This 8.3 is pretty normal. We'll see that today. Risk premiums are usually in the 4 to 6% range, but with interest rates so low, you get really big risk premiums. So that sounds high to me, but today, if we were using a 4% treasury, this would only be 4.3%. So it really is very sensitive. So we got 0.0152 plus 0.0678. Everybody with me so far? The 152, that's the risk-free rate. She made some adjustments there. The 678 is dividend yield plus buyback yield plus expected earnings growth. Take that minus the risk-free rate, we get 6.78. So all we need is the beta then. So we have 4 steps. Someone tell me the 4 steps. Can anybody remember off the top of your head? Revenue sensitivity. Yeah, operating leverage. Financial leverage. And then look at the history. All right. So first of all, on revenue sensitivity, is this a defensive or cyclical company? Dollar General, is it pretty obvious? Definitely defensive. Someone was telling me It's unfortunate in their name, Dollar General, that I haven't been in a Dollar General. Is everything a dollar there still, or they changed that? They
No,
don't?
it's a discount retail basically, but they do have a very small section of dollar items, but.
Okay.
I do retail well-known brands.
Yeah, it's hard to keep breaking things down smaller and smaller and smaller to get everything a dollar, especially if you're gonna sell Cokes and those kind of things. That's just, it's almost impossible. So, all right, then operating leverage. The only thing I give here is the net margin. My argument is the more volatile there's, or more, the higher standard deviation in my margin, the more operating leverage they must have. How do they look versus the average? They look well below average, right? So they're a bit tough. Margin, standard deviation is below average, implying low operating leverage and thus low beta. So what's in my answer here? First of all, this word right here. Don't on the exam say their EBITDA margin, sorry, standard deviation, EBITDA margin is below average. We don't know that. I didn't give you information. We don't know their EBITDA margin. All I'm giving you is the standard deviation of their margins. So don't tell me their EBITDA margin is below average. Their EBITDA margin standard deviation is below average. Everybody understand that? Okay. Same thing on your paper 3. I have students say, wow, their EBITDA margin is 2.29%. No, it's not. I don't know what it is, but it's definitely not that low. That's the standard deviation of their margin. It's below average, implying low operating leverage and thus a low beta. Now on paper 3, you got to say a little more. So is this a firm that has salaried employees or hourly employees? Probably hourly. That probably reduces it. They have a lot of cost of goods sold that move with their prices, so that keeps their standard deviation low. You know, just you have to think on paper 3, you have to add a little bit more than just that chart. But on exam, the chart's probably good enough. Then financial leverage, here's their debt to equity. It's 204%. That is their debt to equity. Unlike here, I didn't give you the standard deviation of the debt to equity. That's the actual debt to equity. Well above average. Much higher financial leverage. 204.02% debt to equity versus stock market, raising their betas. So what is it going to do to their beta? We say this is below 1. This is going to push them above 1. No, it's going to raising their beta closer to 1. It's not going to make them, you know, they were 0.5, now they're 1.4. It's going to just push them up a little bit higher. And in history, you look at history, the median is somewhere around 0.7 something, but recently it's been much lower. History somewhat implies, I think I heard Leo's team saying between 0.4 and 0.8. And that seems reasonable. So I might say definitely, well, below 1, but high debt. I will use, I don't know, 0.7, whatever. There's no right answer there. There's wrong answers. Therefore, I'm going to use 2.7. That would be a wrong answer. Right, but 0.7, anything in the 0.4 to 0.8. Even back here, you say, well, that's the higher end, but that's really revolving around 0.8. So it really doesn't make sense to go above 0.8. Back here, who knows what was going on back there. So, and they did buy Family Dollar, right? Didn't they here somewhere? That might have had some impact on them as well. All right, so that gives me a 0.7. We put all that together. And I get 6.3% or 6.266. How many teams got something in that neighborhood? Did y'all got answers? Some of y'all get answers? All right. Is this one we're gonna have to practice again, or did y'all get it? Any team say we got it, or is somebody like, all right, so part of you got to figure me out, but this is a question I think most people in finance that had a few would have figured it out because of experience. So I don't think I wrote such a squirrely question, but students have trouble because you're trying to figure out my thinking. I've seen this. I know some firms that have interviews, they give these case studies and students bring them to me and I'm like, that's so weird. Ford has one where I think it's actually a trick question. I think the obvious answer is one thing, but they're trying to trick you to do another thing. I saw one the other day where I'm thinking, this whole thing is, they're just seeing if you'll go for the bait. There's a really obvious answer, but they're giving you all this extra data and hoping you'll go for it. So I think they made someone do like that. I'm not doing that in my question. I'm giving you data. I think a lot of it is, most people do well on this if they have experience in finance because they just know what the components are. It's like, I need these 3 numbers. They may not know this 4-step process. It's not well known. Dr. Damodaran uses this exact same process. We just magically come up with the same process. So they may not think that, but they would definitely think that. They would definitely think that, and they would definitely look at that. Operating leverage is the one, they may not know what I mean by this. So that was one, like, why is it giving us the standard deviation net margin? So that one would be one. They might think about it. I think a small percentage of people with experience in finance would even bring up operating leverage. So that's the only kind of weird one on my list, but I think it's really, really important. You should bring it up. So I think the industry is probably wrong on that. Do you have questions on that? If I were to give you this again next week, would you do better? You think? If you do better on the exam, that's the main thing. I want to get exam grades up as high as possible. I'm weird. I like students to do well on my exams. So you'll have professors that brag how badly students do on their exams. And you're like, what's your problem? Why would you brag that you taught so poorly and no one did well on your exam? I don't understand that philosophy. All right. Yeah, how did the markets actually close? I guess, oh, wow. It just closed 546. Wow. Tech stocks, 7%. Dow, that's been doing really well lately, didn't do so well. Tech stocks did well. Remember, growth stocks like lower interest rates. That's probably a big chunk of that. Small cap stocks did well. Why? Because the Fed raises rates, they're gonna have a recession. They don't like recessions. Crude oil is up. Why is crude oil up today? That's kind of strange. Why is gold up today? There's a good question. Why would gold be up today? Dollar is probably weakening. Let's see. It's $1 down today. It is against the euro. Yeah, it's down today. So that would make sense. Because gold should like higher inflation. So that one's kind of a tricky one. I'm kind of a little surprised gold's up that much today. But gold has been really hurt by the dollar. So maybe the dollar relief. I was talking about getting in the European stocks mainly because the dollar has got to weaken. I don't know how European stocks are doing. Let's see. I can't spell Vanguard. Developed markets, VEA. It's up 553. How much of that is currency? How much of that is, so remember, you can go to the Bloomberg machine and actually, adjust it for currencies and see what's going on. So yeah, it's a great day for the markets, no question. All right. And those markets closed a long time ago, but the ETF, they're going to adjust for that. They know, markets are moving around, so they're going to adjust for that. This guy doesn't look too happy, but yeah. Now, how did what was the big thing this week was Bitcoin? How did Bitcoin do today? Up 11%. How much did it fall yesterday? So it was at 20. Now it's back up to 18. So it's still down a pretty massive amount, even with that. So I don't know why Bitcoin goes up or down. It's complete random noise to me, but all right. Interesting day. All right, let's keep talking about stocks. So last class, We said you got to get that economic growth as a basis. You got to talk about your industry, talk about your individual company. Your long-term growth is probably going to be tied to the economy. So shorter-term growth, we talked about the PEG ratio that gives you a sense of what. Oh no, look at history, get some historical perspective. You can use capital IQ to do that. The PEG ratio, what the PEG ratio does is tells you what market participants are thinking, what investors are thinking. So we did some of that last week, so that's an easy one to do. And then the last one is the traditional approach. This is what I was taught in college. We can still use it. What the traditional approach says is there's a growth a company can sustain for a few years. And it's based on what the return on equity is. Firms with higher return on equities will have faster growth than firms with low return on equities. And it's actually mathematical. However, when a firm pays a dividend, and they retain earnings, I don't know why this is really poorly worded, but when a firm pays a dividend, that's earnings they're not retaining. I don't know why it's worded like that. So you can either retain earnings or pay it out. If you pay it out, you can't grow as fast because you don't have any money to buy stuff and build stuff. So you can either retain your earnings and grow fast, or you can pay your earnings out and grow slowly. So if earnings per share is $4.74 and they're paying $1.59, then they're retaining $3.15. They made $4.74, they paid out $1.59, so they're retaining $3.15. And that $3.15, what are they doing with it? Well, they're probably reinvesting in the firm. They may be buying new plants, building new plants. Think about Intel. Intel is crazy. What are they spending? $20 billion on a building in Ohio? Could you spend $20 billion on a building? I don't think if you built USA from scratch, you could spend that much money. What would it cost to build USA from scratch? $1 billion or $2 maybe? Yeah, I think. Any ideas? $4 million square feet, 4 million square feet. So 20 billion for a building, that's a lot of money. Maybe they're going to pave it with gold or something, but that's a lot of money. So, or you might buy other firms, buy another company, or you might be like Apple and Microsoft, you just hold it in cash, waiting for something to happen. That's not going to help your growth any. So retention implies higher growth. Now, some CapEx is actually increasing growth. Some CapEx, you just have to do it just to keep you where you are. That's just what we call maintenance CapEx. But for the most part, if you pay out more, you should grow more slowly. And so what the sustainable growth model says is you can grow at a rate that's your ROE times what percentage you retain. So that's a really popular formula, sustainable growth, ROE times retention. Now, there's one huge problem with that. And it's what ROE do you use? And this is what on paper 4, you can go to Yahoo Finance and get their ROE, but that's just their last ROE. Their last ROE is like 43%, but their normal ROE is 10%. You need to normalize it. So add a word here, normalized. Because we just come out of COVID. There's some firms like Moderna, their ROE looks great, but no one expects that going forward. So you need to normalize it, look and see what it is. So how do you normalize it? You could look at the median of the last 5 years. That's really easy to pull out of Capital IQ. So you want to see what's not, because these numbers can jump around a lot. Some firms, you don't have an ROE. So McDonald's doesn't have an ROE. Why doesn't McDonald's have an ROE? Any guesses on that? Where's the return on equity? I never remember where they put it. There it is, return on equity. They don't have a, did I get McDonald's in there? I don't know why they don't have a return on assets, but return on equity. McDonald's is making money. In fact, they've been doing really, really well recently. They're one of those firms that said, hey, we're able to increase our prices for inflation, so our margins have been pretty well protected. They don't have an ROE. Any guesses? They have earnings, $10 billion in earnings. That's pretty good. Well, let's look at their financials. Look at their balance sheet. What do you notice about their stockholder equity? Anything jump out there? The negative number? They're bankrupt. Are they bankrupt? No, they just have bought so much of their stock back. So you can't even calculate. So that's one thing to be real careful of. On papers 3 and 4, you might want to make sure your company has positive net worth. And make sure they have positive earnings. I would look for those two things. You might want to make sure they're paying dividends. However, if you want to do a firm that's not paying dividends, like Alphabet, you can do it, but you got to get with me and I got to give you a number. We'll have to substitute a number for dividends, but you can do it. But it is a little tough. You can do McDonald's, but the problem, you're not going to be able to use all the tools because of the negative net worth. It does mess things up a little bit. I mean, think about it. On paper 3 for beta, you want to know what their debt to equity is. With their equities negative, you don't have a debt to equity, so you can't use that chart. And for sustainable growth, you can't do that because they don't have a return on equity. So it kicks out a few things. So you're better off. But all you got to do is go to Yahoo Finance, click on financials, make sure they have positive net worth, and then click on income statement. Make sure they have positive earnings. Look at their earnings per share. Look at, I mean, McDonald's is killing it. Their earnings are up, what, 50, almost more than 50% this last year. They're doing great. I don't know who's going there, but someone's going there. And there's McDonald's when I go home at 10 o'clock and the line for the drive-through is like 20 cars deep. I was like, what's wrong with these people? Who's going to wait 30 minutes for my, and they're probably all just buying French fries, but boy, who would do that? So McDonald's is somewhat off the list. There's a few others that have that issue. So be careful, like Domino's. Domino's another good example. Domino's, look at their net worth. Negative net worth. Starbucks would be a great company, wouldn't it? Look at their net worth. Why is it the food companies are all negative net worth? I'm not sure why why food companies and not others. So you have to kick them off. But so there's the theory. So normalize ROE, make sure your firm has an ROE. And then retention, if they don't pay dividends, what's their retention? Well, then it's 100%. But what if they don't pay dividends, but they buy their stock back? The retention can be thought out further, because if you buy your stock back, that's the same thing as paying a dividend. You're letting cash go out the door. So you want to somewhat look at that as well. So it can get a little bit complicated. But if a firm has 66% retention and the ROE is 10%, then you expect them to be able to grow about 6% if you normalize the ROE. Now, a firm like Costco, you might have to normalize retention because Costco pays small dividends and then massive dividends every 5 years, and in small dividends, you have to try to figure out what that is average over 5 years or so, because it can get a little complicated. So there's some companies that are a lot simpler than others. Walmart's really simple to do, but you can't do Walmart because Walmart's going to be my example company. So that one's off the charts. All right, so that gives you 3 approaches. The 4th approach I didn't give you here, but the 4th approach is your opinion. So what do you think? So look at what they're doing. What's their industry? Who's their customers? The Gap's been doing really poorly recently. Well, Gap sells clothes. Do y'all ever go to Gap to buy anything? Is that off y'all's list? Like Applebee's. So Gap and Applebee's, y'all don't do that. Why aren't people buying stuff at the Gap? If you had a friend wearing clothes from the Gap, would it just be obvious when they walked up to you? Say, oh, I can't believe you're wearing those clothes. You probably wouldn't be able to tell. So for some reason, the Gap has lost. They were great some time ago. Everybody loved them. They're a really good store. And all of a sudden, they just. So you have to ask, can they do anything to turn that around and suddenly have a new product, new focus? Or are they just done for Crocs? Anybody else buy those shoes anymore? They're still somewhat, they kind of had a little bit of revival, didn't they, coming back here? So, that's what, it's your opinion. What do you think? Who's buying it? So if this is a baby boomer like Cracker Barrel, there's a lot of baby boomers, so maybe Cracker Barrel is going to do well because all these baby boomers are going to go there. I hate Cracker Barrel and I'm a baby boomer, but there are people who love it. So you're trying to think about what's the demographics, who's the customer, what's the product, do they have any new products coming out, those kind of things. Some companies can be really difficult. So Disney's doing all kinds of things. So you'd have to almost look at every individual line of business and figure out how they're growing. It can get really complicated. So you're better off picking a one product company. A firm like Garmin or retailers like a Costco or something like that, where you kind of know what they're doing. They're not doing 50 different things. So your opinion's the fourth one. And then the next thing you have to decide is timing. So if you think they're going to grow 10% next year, but long term they're going to grow 5%, you have to think how many years to go from the 10 to the 5. And that's by far the most subjective one of all. Really tough. Most students in this class get 0 points on that. It's not weighted much on the paper, but most students get 0. Because most students, what they say is that H is half of this. We'll talk about the H model. So if you think it's going to take 10 years and your H is 5, what most students say is, I think it's going to take 10 years to get from my short-term growth to long-term growth. Therefore, my H is 5. You don't get any credit for that. You don't get credit for taking 10 and dividing by 2 and getting 5. You got to tell me how you came up with that 10. And it's creative writing. You got to make some stuff up. It might influence which company you pick, because then you're going to talk about, if you're doing a Tesla, then your thought is, how long does it take for EVs to take over the world? Right now, they're what, about 5%, but they're growing as percentage. So purchases, certainly the high oil prices have helped here recently. You have some basis to say how long that's going to take. You can find all kinds of stuff on the internet to help you with that. That can certainly help you, but others, it's hard to say. So you have to have some basis. So you might actually pick your company because you can do better creative writing on some of these more difficult things to come up with. And then your long-term growth rate, that's when you're going to tie it to the economy. If you think the economy is going to grow at 5%, if you got a big company, you may pull off of that and say, okay, I think the economy is going to grow 5%, but wow, Costco's a big company. Ultimately, they're just going to grow about 4%. Most big companies, once they hit maturity, will grow more slowly than the economy, because new startups are going to grow faster, and the average will get you about the economy. So most firms will eventually grow. Like I said, eventually every company is going to grow population plus inflation. Population growth plus inflation. So I think ultimately that's about as good as you can do. It gets tough with some firms, like a pharmaceutical. You can say, well, they're going to keep inventing new products, new pharmacies. Yeah, possibly, but it's tough. Once you're a $3 trillion company, it's hard to come up with something new that's so great it can offset your other products that are all dying, because one new product is going to grow radically fast because you have these other products that are 99% of your revenues. All right. So we put all that together, and we're going to value the company. So we've already talked about the discount rate. So we've already gone through that. Here's Dr. Demirdaren's and what he believes the market risk premium is. The market risk premium is the light blue. The dark blue is the risk-free rate. And so that's his projection over time. You could probably see his numbers. I didn't update it. So what we're going to do, what I'm going to do this weekend is I'm going to create a video, a YouTube video. I've done it in the past, but I'm going to redo it because interest rates have changed so much. So I'm going to do a video which I'm going to do papers 3 and 4 for Walmart. So I'm going to go through step by step by step. I'm not going to write the paper, but I'm going to come up with all the numbers. You have to come up with all the numbers and write up what you did. But I'll do that, so you'll have something to watch while you're creating your papers. All right, so that should help you. It's a video I'm going to use for another class, so you have to be. The other class is going to go a little bit more advanced, but you might want to do that. The other class is going to run scenarios. So they're going to do best, worst, and best case. You don't have to do that, but if you want to, you can. So you can consider doing that. So that part, I'll try to make that distinction in the video, so I don't have to do 2 separate videos. So I'm going to go through all of this, but we've done all of this already. So this should all look really, really familiar. That looks familiar, right? We've done that. And this. All right. So what models are you going to use? You have to use 3 models. I'm requiring you to all 3 models, and all 3 of these would be on the exam. So we'll get some practice with that. The good old traditional dividend discount model or the Gordon growth model, we're going to use that one. You should have seen that in 3013. In fact, y'all saw all three of these models in my class because they're the same models. We're going to do something, my model, I call it the cap earnings model. On that one, when you use it on paper 4, you're going to have to explain it. Because you can't stick this in your paper and put it on LinkedIn like everybody knows what the capitalized earnings model is, because they don't. So you'll have to explain what the model is. And the last one's the H model, not as popular. So if you put this in your paper and just say I'm using H model, 90% of the world won't know what, 90% of finance won't know what you're talking about. So you might put a few extra words on that one as well. So the way I explain the H model is the dividend discount model, but with an adjustment for a higher growth period. Something as short as that would be good, just to explain what that is. So those are the three formulas. They're really simple formulas. Should you memorize them for the exam? Absolutely not. You should just know them, because they're simple formulas. They're not hard to learn. They're almost the same formula over and over again. So let's try this in Excel. I will put this file out there on Blackboard. I don't know if I can't remember if I put the bond one out there yet or not, but if I'm combining it with the bond one. So let's do Walmart. So if you think about on this paper, it's coming up with assumptions, right? So I'm somewhat breaking the rules. Rather than giving you all these assumptions and see if you can plug them into a formula, you've got to go out and get the assumptions. So on the exam, I give you the assumptions. You just got to find them. But for papers in 3 and 4, you got to go find the assumptions. Really a powerful thing to do. So you're doing what they're actually hiring you to do. So we need a discount rate, and then we need valuation assumptions. So for the KE, we need a risk-free rate. We need a market risk premium. We need a beta. So I'm doing Walmart, so you can't do Walmart. For valuation, we need a KE. We got that above. We need dividend 0. We need earnings per share 0. We need inflation. You'll see why we need inflation. We need growth long term. We need growth short term, and we need H time. Right. So you're essentially writing a paper to get 1, 2, 3. Get 9 numbers. There is some overlap in these numbers. On the market risk premium, remember you're going to use the expected return on stocks, which includes your expected economic growth. Expected economic growth has inflation in it. So you're probably going to have an inflation number there. That's going to be the same as the inflation number there. Your economic growth for the stock market might be the same number you use for the long-term growth of your companies. So you may have some numbers you're going to use from paper 3, you're going to kick over to paper 4. You do have to be careful on the papers. Some students, they give me an expected economic growth in paper 3, the value to get the market risk premium. And then they just use that in paper 4 without explaining it's the same number. You do have to say something. If you think the economy can grow 5.5%, and you're going to use 5.5% for long-term growth, you still have to explicitly say it. I expect this company to grow the same rate as the overall economy. I used 5.5% before, so I'm going to use that again. You got to at least say that, okay? Don't just use 5.5% without any explanation. All right. So for Walmart risk-free rate, well, this one's pretty easy. Now we're just going to use the 10-year treasury. It's now well above where it's been, even though today it's down much lower than it was. It's still much high enough that we can just use it. So the 10-year treasury, 3.83. One paragraph and you're done. What could you add to this in paper 3? Well, this is such a big issue because rates were so low. I might add a historical chart just to show that interest rates are getting back to a more normal level. That would be easy to do. You just type H15 and Google search, bring up the Fed site, gives you all the history on the 10-year treasury. Do you go back as far as you can? Yeah, it goes back to 1962. You can do that, or you could just show the last few years. However, you know, the key is I have students say, what should I do? And you should do whatever you should do. What answers the questions your boss would ask? You know, that's the critical thinking. You don't constantly ask your boss, what should I do this? Should I do this? What does your boss want? They want somebody who can think, come with their own idea, figure out what's important. So you got to make some decisions on your own. Okay, the market risk premium, we're going to get the expected return on stocks. We just did that. It's just going to be some yield plus expected earnings growth. Expected earnings growth. We're not going to tie that. I always spell growth like that. I don't know what my fingers are doing. We're going to put that as function of nominal GDP growth. That time I got the W and I missed the TH. That's what we just did on that exercise. See how that exercise is very, very similar. And in beta, you got the 4 steps. So we're going to do all of those. For Walmart, and we're probably going to get the same number we just got here, which is what did we get before, 835 or something? I can't remember what we just did. We just did it. So the dividend yield for the stock market. So let's do that. How can we do that? Well, the easiest way to do that, when we need to we're talking about the market, the stock market, we actually generally mean the S&P 500. And they get the dividend yield in the S&P 500, we just type in SPY, which is the ETF on the S&P 500. And its current yield is 1.6%. So that is the yield on the stock market. Right? That's pretty simple to do. So we got our first number there. And then expected nominal GDP. Anybody remember that? Expected blank plus expected blank plus expected blank. What are those 3 things there? Expected productivity growth. Expected labor growth. The last one, expected inflation. So where can you get those? Where I gave you those charts before, where I showed you what they've been historically. Remember, productivity was in that 2 to 3% range. It's been really low here recently. 2 to 3. It came back positive. Last night we saw in Investment Society productivity had a rebound this last quarter. Still pretty weak, but at least not so negative. Last night, Alex said these last 2 quarters with this horrible GDP productivity were some of the worst since the Great Depression. So yeah, you're going to get something in that 2 to 3% range, more likely. Labor growth, I have a chart on that. It's been really, really low for the last couple of decades. It's bounced back fairly strongly since the COVID. It's not massive, a lot of growth. You got baby boomers retiring, all that kind of things. So you're probably going to be in the 0 to 1% there. It's unlikely you're going to get greater than 1%. Then expected inflation. The Fed says they're targeting 2%. I talked about that last night. Where did that 2% come from? It's just kind of a random number. The bond market will tell you what they think inflation is. So when I do the video, I'll show you some ways you can figure out expected inflation. But what are your expectations? Now, some students say, well, the last inflation number was 7.7, so I'm going to use that. But that's not the right answer. We're not talking about what inflation has been this last year. We're talking about what do we expect it over the next 50 to 100 years. Do you expect inflation to be 7.7% the next 50 to 100 years? There'll be some major problem in our economy if that's the case, more printing of money. So you got to come up with those, but you have the charts that I've given you. Most students put those charts into the paper. And then on expected inflation, you know, the productivity and labor, that's just really your opinion, looking at the history, what do you think going forward? And in inflation, there's ways we can actually do that. Well, let's say it's 0.025 plus 0.005 plus 0.025. That equals 0.055, you know, something like that. Again, you're gonna probably get something in the 4 to 6% range. Maybe a little higher if you're expecting higher inflation, but your real GDP, which is the productivity and the labor, 2 to 3 is kind of, I think anything above 3 is going to be really, really tough to get. So you're probably going to be in that range. So you get an expected return on the stocks going to equal 0.016 plus 0.055. Why? Because you have a chart that shows corporate earnings growth equals about nominal change growth. So I got plenty of charts that you can use. If you remember that chart. Over the long term, corporate earnings have grown more slowly in the economy, except for just recently they caught up for the first time ever. So the economy grows about 6.4%. Corporate earnings growth has been about 6.4%. So you have some charts you can put in there that are out there on Blackboard that somewhat support your argument. So expected return on stocks, 7.1%. That sounds low, but we'll go with it. We'll see. I might put the buyback yield in there. We'll see. Now I'm kind of thinking, if you did the buyback yield, I need to do some analysis on it. Just haven't sat down to do it yet. But if you're doing the buyback yield, it's going to be probably in the 0.5 to 1.5 range. Historically, last decade, it's been about 1.5%, but it may be slowing down. That's why I want to look and see if firms are really buying back. You saw those restaurants, they're buying so much stock back that their net worth is going negative. So if you do the buyback yield, you'll get 8.6%. So the economy is going to grow. I think 4 to 6 seems reasonable to me. And earnings growth, that's going to be 4 to 6. And then return on stocks, all depends on whether or not you're adding back that buyback yield, but you're probably gonna get something in the 7 to 10 range, I would think. Now, when I started my career, our official assumption for stocks is that they would make 13%. That was insanity back then. That's what we're thinking. It came out of the 80s and 90s, and stocks were making these massive returns. And we say, oh, that'll just keep going forever and ever and ever, which was then 2000 hit, and 2008 hit. We learned really quickly that when things are really, really great, they're probably going to be below great going forward. But instead, we said, no, these can keep getting great. So we're more in the 7-10% range. But just give you some ballparks. You got to use your own opinion. I just want to make sure you don't assume something that's just going to look crazy on LinkedIn. So you want to be somewhere in the ballpark. All right. So I don't know which of these I'll use, but so my market risk premium then it's gonna, let's use the 8.6% minus 0.0383. So there's my market risk premium. And that'll be somewhere in that, I don't know, 3 to 8% range, depending on your assumptions. So that's actually a pretty normal market risk premium. If you go back to Damodaran, 3 to 4, he's got really high, but interest rates are so low. So he's more in the 6% range, but that's during a really low interest rate environment. All right, and then your betas. So Walmart, off the top of your head, what beta would you expect for Walmart? We'll start off above 1 or below 1? Below 1. So grocery stores, but they do sell flat screen TVs, they sell computers. So, you know, that process, definitely defensive. Their margins are very tame. Some of the tamest, very, very low operating leverage. Their debt's about average, and their beta historically has been really low because they did really well in 2008. They did really well in 2020. So I typically, for a Walmart, I'll typically use anything in the 0.6 to 0.8 range. But they've really proven themselves as a low beta stock these last 2 crises. So maybe I should kicked down to that lower range just because they've been so strong at it. So that's going to give me a KE of 0.0383 plus 0.0477 times 0.6. Now, if you want to round some of these, round the tenure of the 4 or whatever, that's, I'm kind of in the rounding camp, mainly because I think it's kind of ridiculous to have such precision when we're really doing this. So yeah, I'm 6.7%. Why use 6.69? It sounds like you have this precision that just doesn't exist anywhere. So I've already got my KE. So what I'm going to do this weekend is I'll finish this up. You'll have that. And we'll also have some practice problems, but the 669 is there. The dividend 0, that's easy to get. Where would you get the dividend 0? Well, I'll just type in their company. I got to type it correctly. And here we don't want the dividend yield. We want the actual dividend. But unfortunately, that's the forward one. So y'all remember what you have to do. You have to hit historical, change this to dividends. And dividend 0 is just the last 4 quarters. So theirs is actually 2.23. Earnings per share. That you can just pull from that front page. Their earnings per share is nice, even number, $5. Inflation, what did I assume? 2.5% above. I'll keep that. Long-term growth. I think the economy is going to grow 5.5%. I'm going to say 4.5% for Walmart because it's a big company, pretty well saturated. And then we'll just have to handle those last 2. All right. So you see what we're after. All right. Y'all are leaving noises, so we'll stop there. So, all right.